Tesla just trounced the earnings estimates for the first quarter of the year despite major headwinds. The company broke new records across the board, stemming from record vehicle deliveries of 310,000. The company earned $3.7 billion or $3.22 per share, far above the analyst estimates of $2.26 and an astounding 246% growth rate over last year. While Elon Musk has predicted over 50% growth for the foreseeable future, he's always referencing vehicle deliveries. But Tesla's earnings are highly leveraged to the sales that they bring in. For instance, the profit from each additional car sold goes right to the bottom line once all the factories and fixed costs are paid for. When investors talk about growth, they're always looking at earnings growth, and now we're starting to see Tesla quickly grow into its high price-to-earnings multiple, which is coming down as a result of this huge earnings increase. Analysts are forecasting $10.53 per share for the year, but these estimates may need to be raised significantly, especially as Tesla's vehicle production rises towards the end of this year thanks to Giga Berlin and Giga Texas coming online. On the conference call, Elon Musk also noted that Fremont was making good progress and now has achieved record output, and the Giga Shanghai factory, which was shut down until now and will negatively affect the current second quarter, is now back up and running at limited capacity. But Elon Musk says it's coming back with a vengeance and will have record output per week this quarter. I like how Tesla doesn't even care about updating their Giga Shanghai installed capacity, which still says greater than 450,000, despite it being probably almost double that. Of course, Tesla has been increasing vehicle prices to battle rising raw material costs, supply chains that have been disrupted, and a challenging environment for the company's logistics as well. Giga Shanghai, for instance, was shut down with no warning, leading to a month of missed production time. Yet Elon Musk and CFO Zach Kirkhorn reiterated the 50% growth rate this year and for many years to come still being achievable, while Elon chimed in on the conference call saying that 60% growth over last year's deliveries may be possible this year. This is important. It's showing Elon's confidence in the ramp-up of the new factories, and he thinks that high volume can be achieved by the end of this year. It's amazing how there's so much going on at the company now, and they're able to make all of these adjustments and try to adapt rapidly to changing circumstances and still deliver a record quarter. The company also highlights a record 19% operating margin, and they've also been able to reduce the company's debt load to almost zero, excluding vehicle and energy financing. Elon was predicting a recession to occur later this year or in 2023, and so one way of preparing for that is to remove debt. Not to say that Tesla has much debt anyways, given its size. It's also important to remember that because Tesla has a backlog of many months worth of orders, the recent price increases haven't yet made their way into Tesla's sales figures. So from the perspective of Tesla's financials, unit prices can go even higher, which again will coincide with rising costs, but that will be a tailwind to revenues in the upcoming quarters. That said, as the company and the entire EV industry grows at such a rapid pace, there's going to be a huge growing pains, which could last for many years. An entirely new infrastructure to support electric vehicles needs to be built out. Even the CEO of competitor Rivian has said that the battery shortage in the future is going to make the chip supply issues look like a small appetizer, and he thinks this will remain an issue for the next 2 decades. Tesla has demonstrated time and time again that despite never-ending headwinds, the company is extremely fast and adaptable, and I think that's one of the overlooked qualities of the company, that they're ready to do anything to keep pushing to achieve their mission, which is contrary to competitors who seem to just shut down their plants when there's missing components. And by the way, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and financial data going back 10 years, and it's all freely available. Now, the battery storage business grew moderately year over year, but solar declined. Elon does expect these businesses to regain their upward trajectory and do well in the back half of this year. Plus, Tesla references the new Megapack factory that has already begun ramping production. This could finally increase the size of the energy business substantially, but will likely also depend on other factors such as battery production and chips, for which Tesla prioritized the more lucrative vehicle business. Tesla also notes that their investment and deployment of superchargers has accelerated as they work to open the network up to third-party vehicles, but this will create a very dominant charging network that's highly competitive. Keep in mind that if Tesla can take business away from competing charging networks, those other networks become harder for competitors to maintain and cheaper for Tesla, which creates this feedback cycle drawing more customers into the better network. It also increases the barriers for competitors to compete with Tesla here as well, and the barriers to entry are already extremely high given that Tesla has the world's largest charging network and is responsible for 2/3 of all of the EVs produced in the US. It's also hilarious that the Super Bowl ads for electric vehicles caused Tesla's US orders to spike, even though Tesla didn't advertise at the Super Bowl. Instead, the ads were paid for by companies such as GM, Volkswagen, Toyota, BMW, and more, but ended up benefiting Tesla. All companies producing EVs are also production constrained, so advertising doesn't make much sense at this time, besides to increase brand awareness. But doing that without a product to sell seems like a waste of money for these competitors. Now, we've also just gotten some more color on the ramp-up of the new factories. For one thing, management has confirmed again that these new factories should ramp up faster thanks to the learnings from Tesla's previous gigafactories, plus they highlighted on the call simplified processes such as 30% fewer robots thanks to the gigacastings. Elon also hinted earlier this year that a new gigafactory will be announced sometime in 2022. And there's a great quote from the call, I believe Lars said it, "If you're waiting for the best car, you'll always be waiting forever. And also, if you're waiting for the best factory, you'll always be waiting forever." So in other words, Tesla doesn't copy-paste gigafactories. There's still plenty of room for improvement for future factories in the years to come. Not to mention that over time, the technologies, such as having 2 gigacastings, will make their way throughout all of Tesla's factories through upgrades. Now, there were some questions about the 4680 battery cell ramp-up. This will still take time to reach its full potential, perhaps up to 5 years. It was interesting that Drew Baglino was being very conservative about 4680 expectations, though he did highlight that the priority was simplicity and scale. Elon jumped in saying that this year, investors should expect that the 4680 structural pack will be competitive with the best alternatives, and will exceed that later next year. So it seems that the ramp-up will lead to more and more efficiencies over time in this highly automated process. They also expect Berlin to switch to 4680s later this year. And while volume production of 4680 cells may occur in Q3 at Giga Texas, there's no risk this year if the deadlines aren't met. 4680 risk could occur next year if the ramp-up isn't solved. So it seems that Tesla is highly focused on this priority, and this will be gigantic for the company. 4680 cells will free up the 2170s being sent to Giga Berlin. And Tesla posted a graph showing their growth in their 3 major markets. Once Berlin is able to produce cells on its own in volume, I think we'll see a big increase not only in Tesla's European market share, but also in China, probably first, because it will free up all of the vehicles and cells coming from China to Europe, and instead they can focus on their own market, the largest vehicle market in the world. In order to produce these cells, however, Tesla keeps talking about getting into the mining business. They've actually been saying this for quite a few years now, and they sort of alluded to that on the Q1 call. The single biggest cost growth for battery cells was lithium, even though there's only 5 kilograms of lithium in each car, according to Drew Baglino, who's a senior VP of Powertrain and Energy Engineering. It doesn't seem like getting the lithium itself is a problem, as per the comments by management. It's an abundant material. However, Elon Musk notes that refining the lithium is the limiting factor, and building a lithium refinery per se is a 1 to 2 year project. And Elon says, "We think we're going to have to help the industry on this front." While they've been talking about this for a while, it appears that in the coming months, Tesla will have an exciting new announcement to make, potentially about their mining operations. I also think it'll be interesting to hear if there will be a bigger partnership with Tesla co-founder JB Straubel's Redwood Materials, which recycles parts for materials specifically for EVs. Tesla is also doing its own recycling, feeding back scrap metal into the process, and also they mentioned using aluminum wheels from legacy cars in order to melt it down and make EV parts. Now, Elon Musk is getting excited about a new vehicle that Tesla aims to have volume production in 2024. This will be a dedicated Robotaxi, something that Tesla has showed us under the covers back at the Battery Day event. The vehicle won't have a steering wheel, pedals, and as Elon mentioned at the Cyber Rodeo, should look quite futuristic, and it aims to have the lowest total cost per mile. He says this is a powerful product, and Tesla is investing in capacity for this vehicle right now. This is also a sign that the company is becoming increasingly confident of FSD and the Tesla network becoming a reality in the coming few years. There are currently over 100,000 people in Tesla's FSD or full self-driving beta program, and Tesla is looking to increase that to an even wider set of people. We've also seen investment firm ARK Invest make the calculations of Tesla's cost per mile, but they're using the current vehicle lineup, so a dedicated Robotaxi could even beat their high expectations for drastically reducing cost, which will be a massive driver of growth for Tesla, likely more so to do with software and services rather than selling these vehicles to customers. Elon also talks about the Tesla bot Optimus's potential, emphasizing once again that the robot will be bigger than cars and bigger than full self-driving and autonomy. This makes sense since it will aid and replace labor, but depends mainly on Tesla's ability to create real-world AI. I don't think most people or anyone is really factoring this into their Tesla valuation. But I think if Tesla can show that if they can master full self-driving, obviously that will create a massive robotaxi business. But then I think that ability will better allow people to wrap their heads around the potential for Tesla Bot's AI and productizing it, which will then quickly make its way into valuations. And the Tesla Bot seems like it would be much easier to produce than a car. It's much smaller and requires fewer batteries, but needs state-of-the-art software. Switching gears to Tesla Insurance, Tesla just launched real-time insurance in 3 new states this week. This real-time insurance now fully completes the loop. It's sort of revolutionary actually, a completely vertically integrated vehicle combining insurance with repair and production engineering. Tesla is also the underwriter and takes on the risk. That means if there's an accident, Tesla right away gets the notification, prepares the estimate, they set up the repair appointment with themselves since they own all of the service centers, but this allows them to identify cost inefficiencies and feed it back to the engineering and software teams to improve the reliability of the product. And this will reduce costs or the chances of even getting into that type of accident again in the future, especially if the software team can find an improvement for the collision avoidance system or design the vehicle differently. Tesla is already the second largest insurer for their own vehicles in Texas and expects to soon be number 1 within the next few quarters. They're already seeing customers having much lower costs, and they are changing driver behavior to improve driving by giving them feedback, which is working. So overall, this will be a cheaper, more automated, and better customer experience. This is going to add huge competition for other insurers, which was Tesla's initial goal, to lower premiums for their customers and actually make the vehicles more affordable and accessible. By the end of this year, Tesla aims to give 80% of the United States access to Tesla insurance, and then they will begin expanding to new countries. So what do you think will be Tesla's largest or most exciting business in 5 to 10 years from now? Will it be vehicle sales, the Tesla network, insurance, the Tesla bot, or something else? Don't forget to check out my video on Tesla's new Gigafactories. Please hit the like button and subscribe. We would really appreciate that. And a huge shout out to all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.